If COMEX really is breaking, then the silver price you see on your screen right now is already a lie. Not later, not soon, right now. And once this cracks publicly, prices won't drift, they'll snap, violently without warning and without giving anyone time to react. At first glance, nothing looks wrong. Silver trades, charts update. Analysts argue over minor moves like this is just another normal week. But here's the part no one explains clearly. When a system is under real stress, it doesn't scream. It stays quiet. It keeps functioning just enough to maintain confidence. And right now, silver is doing something that doesn't line up with how a healthy market is supposed to behave. You're told silver prices reflect supply and demand. Simple, clean, transparent. But what most people miss is that the price you see isn't the price of silver. It's the price of paper contracts, referencing silver. And those are not the same thing. They only appear connected as long as everyone agrees to pretend they are. This is where it gets disturbing. The COMEX market isn't designed for most contracts to ever result in physical delivery. It's designed for rolling, offsetting, settling in cash, and moving on. That works fine until too many players want the same thing at the same time. And lately, something has changed in that behavior. On the surface, inventories still exist. Numbers are reported. Vaults are listed. Everything looks orderly. But here's the contradiction. The more silver that's supposedly sitting in registered inventory, the more stress the system seems to show when delivery pressure rises. That shouldn't happen in a balanced market, yet it keeps happening. Ask yourself this. If supply were truly ample, why does even modest delivery demand cause visible strain? Why do spreads widen? Why do settlement incentives quietly increase? Why does the market suddenly prefer cash over metal when confidence is supposedly high? And that's not even the worst part. The worst part is how carefully this tension is being managed out of public view. No headlines screaming default, no official acknowledgement of stress, just subtle adjustments, rule tweaks, timing changes, small signals that most people never notice unless they're looking directly at the mechanics. But here's the part no one explains to everyday investors. A default doesn't always look like a failure to deliver. Sometimes it looks like a system doing everything possible to avoid delivery in the first place. Delays, substitutions, incentives, anything to keep metal from actually leaving the system. This is where the idea of breaking gets misunderstood. COMEX doesn't need to shut down to break. It only needs to lose credibility as a place where price discovery reflects physical reality. And once that credibility cracks, even quietly, the price signal becomes unreliable. You're watching silver prices move within a range that suggests calm, but beneath that calm, something feels compressed, like pressure building behind a wall that still looks intact. That's usually how sudden repricing events begin, not with volatility, but with unnatural stability. Here's an unsettling fact. Historically, when commodities disconnect from their physical constraints, the correction isn't gradual, it's abrupt. The longer the disconnect lasts, the more violent the snap when it resolves. Silver has a long history of this pattern, and the current setup fits uncomfortably well. Publicly, you'll hear explanations about interest rates, the dollar, industrial demand, and sentiment. All reasonable, all incomplete. Because none of those explain why delivery-related stress keeps appearing in a market that is supposedly deep and liquid. This is where it gets disturbing again. Large players don't wait for confirmation, they move based on probability. And probability right now suggests that too many claims exist on too little immediately available metal. That doesn't guarantee a default, but it does guarantee tension. And tension changes behavior. It makes participants more cautious, more defensive, less willing to part with physical assets. That behavior feeds on itself. The more people hesitate to deliver, the more valuable delivery becomes. Here's another contradiction. Silver is treated as a small market, a sideshow, too insignificant to matter systemically. But at the same time, enormous leverage exists on top of it. Paper leverage that only works if very few people ever ask for the real thing. If silver truly didn't matter, it wouldn't need such careful management. It wouldn't need constant reassurance. It wouldn't need narratives to explain why nothing unusual is happening. Silence would be enough. But silence isn't what we're seeing. We're seeing explanation overload. This is where you should pause. Because when systems start explaining themselves preemptively, it's rarely because everything is fine. It's because they're trying to shape perception before reality forces the issue. Now think about this. If a visible default occurred, confidence wouldn't just crack in silver. It would ripple into other paper-based commodity markets. It would raise uncomfortable questions about how many prices are signals versus assumptions. That's why the system works so hard to avoid that moment. Not because silver alone matters, but because what it represents does. The trust that paper promises can always convert into physical reality if needed. But here's the part no one explains honestly. Trust doesn't disappear all at once. It erodes, slowly, quietly, through inconsistencies that get explained away one by one, until suddenly people stop accepting explanations. Look at how language changes during these periods. Temporary, orderly, plenty of supply, no cause for concern. Those phrases appear when concern already exists. They don't appear during genuine stability. And that's not even the worst part. The worst part is timing. Because when repricing finally happens, it doesn't wait for retail participants to understand it. It moves when liquidity is thin and confidence is fragile, when reaction time is limited. This is why watching silver right now feels different. Not dramatic, not explosive, just tight, constrained, like a market that's being held together rather than flowing naturally. You might wonder why this hasn't already resolved. Why no explosion yet? The answer is simple and uncomfortable. Systems can remain under strain longer than most people expect, as long as confidence holds. But once confidence shifts, the unwind is fast. And here's where it gets disturbing again. Confidence doesn't need proof to change, it only needs doubt. Doubt that the next delivery request will be honored. Doubt that prices reflect reality. Doubt that rules won't change under pressure. Once doubt spreads, behavior changes instantly. Paper holders start thinking about optionality. Physical holders start thinking about scarcity. And the gap between those two mindsets widens. This is where the public narrative falls apart. Because you'll still see charts, still see prices, still see commentary acting like nothing structural has changed. But the behavior underneath tells a different story. Silver doesn't need to break to expose the problem. It only needs to remind participants that metal is in T infinite and promises aren't T the same as ounces. That reminder alone is enough to force repricing. Now here's the key connection most people miss. The price on your screen is a confidence signal, not a scarcity signal. It reflects what participants believe they can get away with today, not what metal is actually worth under stress. When confidence is high, paper prices dominate. When confidence slips, physical reality takes over. The transition isn't smooth, it's sudden. So what does all this actually mean for the market and for you watching it unfold? It means the calm you see isn't reassurance, it's compression. It means the absence of headlines doesn't equal the absence of risk. It means price stability can sometimes be the most dangerous phase of all. No new facts are needed to understand this moment. Everything required is already visible in how the system is behaving, in the quiet adjustments, in the careful language, in the tension that doesn't resolve. COMEX doesn't need to announce a default for the silver market to change forever. It only needs enough participants to question whether the price they see truly represents the metal they think it does. Once that question takes hold, the market doesn't drift, it revalues. That's the real risk hiding beneath the surface right now, not collapse, reassessment. A sudden shift in what participants believe is real versus what they were willing to accept. And when that shift happens, it never asks permission. It doesn't wait for consensus. It moves. Now you see what most people don't.